Did I cut him off? Or did I wait long enough? Um, what's up, Preef? PJ? Reef? I waited too long? No. I really didn't want to cut him off. I just thought it would be kind of funny. Okay. So I've got a half an hour to cover a topic here that is on option pricing and risk management. By the way, today's been not the easiest day to trade. The last 3 days have been a little easier, and you can just kind of see in this just sort of chop and sort of weak indices. Um, it's been crazy, but I've been really happy with not only the way I've traded during this open house, but the way all of us have. I think everybody's in a really difficult market and made some good money. So throw a let's throw a 7 in chat if you've made some money this week. Let's go. I love it. Love it. So, if you've made some money this week, you should reach out and pat yourself on the back because it has not been an easy week to trade. And so, if you've been able to manage emotions and kind of manage risk, which is what we'll talk about here in a second, and you've made money, then you've done a great job. And if you haven't, then this is the place to learn how to do that in a difficult market. Like if we can do this in a difficult market, imagine what happens on weeks where the market's moving smoothly and in the right direction, right? For a lot of us, it takes time to understand how all of these components work together, and time, that whole 10,000 hours to master something kind of mentality is just being in the market and around the market time and time again, making trades, making good trades, making bad trades, taking notes, making sure you have a trading journal. That's what makes that's what continues to make you a better and better and better trader. And so, along those lines, I want to do something kind of simpler, base it down a little bit for everyone that's new, which we will get into. I'll do a much larger version of this kind of a trading if you join during our after hours beginner learning sessions that myself and D-Man are going to do. I'll do a full hour on options 101. Yes, Ahmed, we do talk about trading psychology quite a bit because it's once you learn once you learn how to trade, trading psychology is what makes you being able to manage your emotions, being able to understand what other people are doing, being able to understand why you do certain things, you personally, what your trauma is, really helps inform what kind of trader you are and what kind of changes you want to make, right? So we talk about that a lot. D-Man has a very good, like hour and a half long presentation he does on psychology. I also talk about it a lot. Nate talks about it a lot. And so that's the value of having a community around you, is that when you make a mistake, you can ask questions and find out what other people are thinking and doing in that same in that same environment. and find out. Really, the trick to psychology is finding out why you do certain things. Whether you're the type of trader that makes mistakes based on hope, or makes mistakes based on greed, or makes mistakes based on fear. There are a lot of things that can affect your entries and exits and profit taking targets and all that kind of stuff. And it's really, really important to kind of learn what that is, and learn how you react so that you can sort of stem those reactions sometimes. My biggest mistake is generally that it's taken me so much time to get over, and I still make this mistake from time to time, is when a trade breaks down, I am forever hopeful that it will come back. And so that's a psychology that I have to continue to tell myself. Trade's broken, get rid of it. Trade's broken, get rid of it, right? Because I can always get back in. But the psychology, and this isn't a session on psychology, so I want to get to the options part. The psychology of it is, well, once I close the trade, it's a loss. But if I don't close it, it's not technically a loss, right? But that losing trade gets worse and worse and worse and worse, and then when you close it, it's a much larger, or you're forced to close it, it's a much larger loss than just saying, oh, it's not working, it's gone. It's not in. I don't care that I just had a loss, because as traders, we take shots. Some work, some don't. We manage those losses. We extend those wins, but we have to not get emotionally involved in the losses. Hey, it's a loss, no big deal. Cut it. I cut it. I'm out. Yes, I am recording this, but the actual session is about option contracts and how to manage that. Manage your stops and manage your risk. So I'm going to use an example from Tuesday when we did a trade plan on Nike. Okay, so I'm not suggesting this is a setup we get into, but I'm going to use it as a good example because I created a trade plan here using the March 7th option contracts. So I'm going to pull those up. Okay, so when Nate Bear or myself is playing a TPS style trade, right? Most of us use options in here. D-Man will use both. He'll use stocks and options. But a lot of the trades we make in here, whether they're a lotto trade or a TPS style trade 3 or 4 weeks out, we use option contracts. And the benefit of the option contract is that you can control 100 shares of stock, right, for a predetermined amount of time, right? Whatever that amount of time is, that's, in the February 28th expirations for this week on Nike, that's 1.5 days essentially, right? For the March 7th, it's 8 days, or probably 7.5, right? Because we're already halfway through the day. The March 14th is more like 14 days. So for each individual contract, each individual option contract, you are controlling 100 shares of a stock for a predetermined amount of time. Now, there's all kinds of things that affect the price of that, right? You have intrinsic value, you have theta, you have delta, you have gamma, and they all change and affect the price of that option. But I'm gonna show this right now to help you figure out stop losses and risk management with options. The only thing we're going to focus on at the moment is delta, and I'll mention theta. Okay, so delta, these are called the Greeks, right? These are what affects option pricing. Delta is the value of the strike price in relation to the underlying stock. Okay, so the category here, delta's here for all of these option contracts. All right, and we typically buy option contracts right at the money. So we're either slightly out of the money or at the money, right here. Okay, this is in this week's option. So let's actually look at this example for later. And these are going to be hard to read because they're kind of small. I don't know how to make them bigger, but you can zoom in, right? So if we're going to buy the March 7th calls here in Nike, we can, the $81 calls, 80 and 81 are over here for March 7th. You know, the 81s are going for about $1.15, 16 if you were to split the bid and the ask. And the 80s are going for about $1.63-ish, right? If you kind of found the middle. And so if you buy one option contract, let's say we bought the 80s at about $1.60 per option contract, you are controlling 100 shares for $163. Okay, these are the option. This is an option chain. These are the different strike prices. Okay, these are the dates of expiration. They go all the way out. You can go out 2 years, 3 years if you want. But I'm choosing next week's, and we're going to look at the $81 calls for this example. Okay. So what I'm looking at here, let's go back to the chart. What I'm looking at here is we're looking at taking an entry in Nike. Let's say, I'm not recommending this as a trade, so I'm just using this as an example. So the March 7th $81 calls are currently going for, let's just say, $1.20. Okay, as it fluctuates. It's a little less than that right now, but let's just say it's $1.20 per option contract. Okay. And so if I'm going to put on 10 contracts, how much would that cost me to put on 10 contracts of Nike? That's right, $1,200. Okay. So our total cost to put on this trade is $1,200, right? You could put on one contract, you could put on 5. I'm just going to use nice round numbers so this helps to make sense for everyone. Okay, yeah, 1,200 plus commissions. That's right. Okay, so let's just say 1,200. So if we buy the March 7th $81 calls for $1,200, and we want to figure out, okay, I'm at 80.57 when I take this order, when I place this order, and I'm going to put a stop in down here at, this low, right? We have kind of a support low here, and we have a swing low here. So that's where I want my stop. And so I am going to risk on Nike, the underlying stock, I am risking darn near $1, right? We're sitting at 80.59 and our stop is at 79.62, right? So for the sake of, this example, we are going to risk $1. That means if this were to work its way down here and break our stop, we would stop out of this option contract. Okay, so that's our risk. Our reward would be higher. We'll talk about that in just a second. But let's say we were shooting for, in this example, we were shooting for 80. Let's go 83.50. Okay. Now I did a session on how to calculate what your risk, what your target is. Let's put this up here. What your target is and what your stop loss is. So if you want, you can go watch that video. I won't get into that right now. I'm picking a relatively arbitrary number. Okay. But, okay, so this is a great question. Beppe, you ask, so the risk is $100. That is not quite right, and I'm going to explain why, but that's a great question, right? That would be the way you would think. But we're controlling 100 shares of the stock, but we're not controlling it. Man, I wish I could get rid of just a couple of those lines because I want to keep the other stuff up there. Oh, yes. Yes. Okay. So this is the important part. Because we're buying the at the monies or slightly out of the money here, right? We're buying this option contract, the 81s. Our delta is 46. And so it's close enough to 50 that I'm just going to use this as the example, okay? So our delta is 50. Okay, so that means for every $1 move in Nike in the underlying stock, our option contract is going to move 50 cents, or in this case, 46 cents. Now, as it moves, right, the delta changes. So, it's not exact, but that's a good way to just sort of get an idea of, oh, I see. That means, Sherry, the question is, what's a good how am I deciding which option contract to take? This is a pretty liquid option, and so you could go with the 80s if you wanted to. You could go with the 81s. You see the 80s, right, have a 58, so almost a 60 delta, which means for every dollar move, they're going to move 60 cents, right, per option contract. And you can see the delta goes up as you go further into the money, right, and it drops as you go further out of the money. And so when we're looking at option contracts, if you're saying, okay, I'd like to play Nike, well, I could come down here and buy the 86s, way down here for like 15 cents, and I could buy 100 of them, and God, I'd make so much money. Well, you're only going to get an 8-cent move for every dollar move in the underlying stock. Now, that works well in a lotto when we know that's going to work right away, right? But the other thing you have to start being concerned with is anything that's out of the money, you start to have to worry about theta. And the further out you are, theta is less of an issue, right? Theta starts to deteriorate your option pricing, right? When you go further out, so if we look at the, April 17s, let's see, the 86, well, can't even see the 86. Well, let's see. So roughly 86 would be about right here. So going out to April 17th on an $86 option or thereabouts is going to cost you $2. And if you go out to March 7th, it's going to cost you 15 cents. So when you go further out, you're buying time. And that's theta, right? And theta ramps down. If there's a graph for theta, it ramps like this. It takes the value out of your option, especially when you're out of the money, because there's no intrinsic value in that, right? All the intrinsic value is in the money. All the out of the money is, theta, some delta, some gamma, right? That makes those prices. So that's why when an option contract is about to expire, it goes to zero. Generally, unless it's deep in the money. Okay, so if we're buying If we say, okay, we want to buy the 81s, that's what we want to buy. I got rid of all the drawings. Sorry. Okay, so we're in for 1,200, 10 contracts, right? At a $1.20, and our delta is 50. Okay. So if we come down to our stop area, if this drifts down to our stop area and it moves that $1, right? What is our total value of our investment going to be? Yep. So give or take, these are just nice round numbers, right? If it happened immediately, and it didn't take a few days, our total value would now be 700, and our total loss for this trade would be $500. Okay. So when you get into this trade, if this is the trade you're making, right? If you're making the March 7th $81 calls that are currently at a $1.20, your stop loss is $1, right? And that varies. It could be a 50-cent stop loss. It could be a $6 stop loss. I'm just picking these nice round numbers so that it makes sense to everyone. Sometimes you actually have to do some math. Okay? So with those 10 contracts, our total investment is 1,200. Our total loss would be 500, assuming we took our trade off right there. Okay? If you do the thing that a lot of beginning traders do, and you let that trade drift to here and then hope a little bit more, and then drift to here and hope a little bit more, pretty soon you're down 50% or more, and your options are worthless, right? So you have to be willing to, or have to be disciplined enough to stop out to maintain this loss right here. So is there any questions on that? Now, the reason option contracts can be so you can hit these 100% winners, right? Is because as this moves up, right, the delta also moves up. So let me get rid of this. So for every dollar move, so 851, 8051, sorry, 8150, 8250, 8350, right? For every dollar move up, your option contract's delta goes up. So not only do you get, your roughly 50-cent increase for a dollar move, right? But now, let's say we were buying the 81s, right? Now the 8150s are a 60 delta. So for the next dollar move, you're going to get 60 cents of value. And then once they hit that dollar, you're now getting roughly 70 cents per dollar move, right? That's why when an option contract, like a lotto or any option contract, when it goes and it really wants to move quickly, you can ramp up that value pretty quick because you're using leverage. Okay? So basically, the best way to figure out, so if you go deeper into the money, like if you wanted a 1-for-1 move on Nike, let's say you wanted to take this trade, right? And you said, well, I don't want a 50-cent move. I'm going to come all the way up here and buy the 74s, and I'm going to get a 1-to-1 move. For every dollar move, the option's going to move a dollar. Right? And you're buying way, way, way in the money. And that's okay too. You're just paying up for it. Right? You're just paying more per contract. Does anybody have any questions on that? The value in this lesson really is from Tuesday, I talked about how to make a trade plan, right? How to understand what your risk reward is. So in this case, we use our little risk reward tool. We're buying right there. We're stopping out $1 later. Our target is up here. And you don't want to set an arbitrary target and an arbitrary stop. You want to learn how to calculate those. And that's in my lesson from Tuesday, which you can go find on YouTube. But now I know I have a 1 to 3 risk reward, right? I'm risking, in this case, it's 93 cents, roughly $1, to make $2.88 on the underlying stock. I want to make sure I'm a 2 to 1 or better in my risk reward. And then, I can be a 50-50 trader and still be profitable. Now, does anybody have any questions about this directly? And for those of you who are joining us next week, we're going to do a whole intro series after the market closes. I think starting on Tuesday, the mods will be able to back me up on that or tell me I'm wrong. Either way, starting next Tuesday after hours, so there's not other things going on, other people posting trades, where you can ask questions. All the experienced traders can go about their day, but for all the beginners, we're going to go back to the very basics. My first session is going to be on charts, right? How to set up your charts, what charts mean, and then candlesticks, how to read candlesticks and what they mean. And then we'll just go for there. I know D-Man's going to do a couple of sessions, and then I'm going to do another one on options 101. We're going to talk about delta. We're going to talk about theta. We're going to talk about gamma. We're going to talk about how the option contracts are priced, and how they move. Because that's one of the primary tools we use in this room are options. And if you've never traded an option, they can be kind of scary. But they're really not once you understand them. They're very powerful once you understand them. Does anybody have any questions for me before I hand it off to D-Man? I usually use a dollar amount when I'm calculating my stop. And then I use I just use my eyeballs to see if the chart has broken down. I can do a lot of this in my head, right? Because I've been doing it for so long. But I highly recommend learning to do it, calculating it, writing it on your charts. So because if you have something that you're gonna put on, let's say your max contract, your max position size is $1,500, let's say, right? That's the largest position I'm going to put on, but I'm only want to risk $250. I'm only willing to lose $250, right? For every $1,500 position that I put on. That's whatever, let's just say that's your risk tolerance. Could you put this trade on with 10 contracts? Right? No. If your max position was 1,500, you certainly could. You could put on more. But your max loss, because you're risking $1 on the March 7th 81s, you cannot. You can only put on 5 contracts. But understanding that is super important. Right? That way you don't put on too many contracts just because this is your max position value. Well, you're not risking $250, are you? You're risking $500 or $600 in this scenario. Okay, that's it for me. D-Man, are you here? Hope that was helpful. D-Man does have a YouTube channel. Paging Demand.